Welcome to this edition of Business Redefined. As always, your weekly most comprehensive look at the world of business, finance and economics. It's a busy week. The annual World Bank IMF spring meetings have kicked off in Washington, D.C. and the World Bank has released the Africa Pulse report this month, that is April 2024, focusing on nuances around the macroeconomic landscape in this continent. One of the issues emerging is that it sounds a little bullish or optimistic about the economic outlook, and we are joined and privileged to have on set the Chief Economist for Africa from the World Bank, that's Mr. Andrew Duberlin. Andrew, great to have you here.
Thank you, Julian.
Let's kick off our conversation.
For having me.
Thank you so much, Andrew. Let's kick off our conversation. You talk about a bounce back in the sub-Saharan African region, and when I read the report, it again gives a measure of caution, speaking about the recovery is fragile. Sounds like a mixed bag to me. When you look at your calibration of risks, are you still skewed to the downside? Are you seeing more upside coming up?
Julian, thank you so much for having me again. Well, I think, the recovery that you picked up on is primarily driven by private consumption. As declining inflation boosts household purchases, and the other two drivers, investment and government consumption, we see are subdued. Investments because of high interest rates, and government consumption because of the consolidation that is taking hold across the continent. And when we look at then the downside risks, we see that in fact they're mostly tilted towards down. They're mostly tilted downside. And for two reasons. One is external, and the other one is domestic forces. Let me just give you the external forces is primarily going to be driven by slower than expected global economic growth, which, especially if in fact the activity in Europe and China gets subdued. So far, we've seen more than resilient bounce back from the US economy, but there are signs that in fact that may not hold for a long time. The thing that we're watching the most is actually what's going on in the Middle East. As you noticed the last few days, there has been a significant escalation of conflict there. And what we worry most about that is the possibility that the price of oil will rise, and that if the oil prices go up, this could really fuel inflation and keep interest rates very high in the US and Europe, which will then lead to currency depreciations and devaluations and ultimately lower growth. So that's one thing that we're most worried about externally. Internally, the main risks are just these unresolved conflicts and violence in the region. And then, that's compounded by climate risks. Southern Africa has just declared emergency over drought. There are floods going on in Eastern Africa. And then finally, there is, a lot of elections are coming up in Africa. And as usual in Africa, elections are a source of instability, unfortunately. Typically, it's not just political instability, but also financial, macroeconomic instability because, governments tend to spend higher, wage bills go up, fiscal deficits go up. And then, and that usually fuels inflation and therefore drag down growth. So that's the kind of downside risks that we are most worried about.
Andrew, that's a very good way to pivot into the latest development we've seen in the Middle East between Iran and Israel. Just how much does this compound the conversation we have long been having around a poly crisis? We came from COVID-19, we went to Russia, Ukraine. Here we are now between Iran and Israel. Just how much does it complicate the macroeconomic landscape for Africa?
It does. It's precisely because it might actually, right now we've seen inflation come down in Africa, and there is a real concern that in fact if oil prices begin to edge up, and 18% of oil consumption in the world comes through the Persian Gulf. So if that gets disrupted, it will definitely increase inflation. And just when we think that we've actually brought inflation under control, it might then, get out of hand, and that's the main worry here.
Andrew, the report released by the World Bank talks about growing debt service obligations, creating liquidity problems. In the recent past, one of the debates we've been having around this is whether we are actually mispricing solvency problems to be liquidity problems as far as Africa's debt crisis is concerned. How would you respond to that? Are we dealing primarily with liquidity problems or solvency problems on the case of African economies?
So for some countries, it was definitely solvency problems. They could not pay the debts. And I think, that was pretty clear. For many countries, it was definitely liquidity. I mean, these countries could pay their debts. It's just that they didn't have the cash flow at the time when the bills are due. In particular, when bills are due in the form of bullet payments, these very large bullet payments, billions of dollars due all at once, were becoming a problem for some of the countries, right? Now, typically what happens is that if, in fact, a country that is facing liquidity problem then gets hit by a major global shock that reverses the growth momentum, puts upward pressure on spending, it's not then inconceivable to see liquidity challenges turning into solvency problems, right? And so that is the main worry. So there is, that's why we always call for these countries need funding that is cheap, that provide liquidity, and does not add too much to their debt burden. So that's what the countries mostly urgently need. And multilateral agencies like the World Bank, IMF, African Development Bank could provide these kinds of concessional financing. So that is the main worry about, the main worry for a lot of these countries is liquidity challenges turning into debt challenges.
Andrew, staying with the subject of debt distress and its resolution, we have seen after almost 24 months of not being able to go to the global markets, we have seen Benin, Cote d'Ivoire and Kenya go, never mind Kenya's punitive coupon for its latest issuance. Is the funding squeeze behind us? Can we comfortably say that?
I wish we could say that, but I doubt it. No, it's definitely not behind us. Just think, take for example, right now in 2023, African countries spend 47% of their revenues on debt services. So that's money that is not available at all for core development, like education, health, badly needed infrastructure, especially in energy access, transportation, roads, railways, you name them, right? So that's off the table already. And then other sources of financing have also dried up. So foreign direct investment flows, which ideally, if you could get a lot of it, will not add to the debt, has been declining. And there is no end in sight that, in fact, it will turn the corner for now. Loan disbursements from China, which has been a major source of financing, has also slowed down substantially. And then, private creditors have basically locked these countries out of financial markets. So, for example, you mentioned Cote d'Ivoire, Benin, Kenya going back to the market. And, there's a slight opening of the door for financial market access, but they're coming at a very high cost. These are very expensive. So for a lot of countries that are under debt distress that are not a Kenya or a Benin or a Cote d'Ivoire, the premium is around 12%. And so they don't have access to those. So I wish we could say that, in fact, we are out of this funding squeeze, but unfortunately, no.
Do you think the developments in the Middle East further complicate that question?
Absolutely. Absolutely.
Wow. All right. Tricky situation there. Looking into the spring meetings, which have just kicked off, are you optimistic that in these meetings we will have something tangible coming out by way of comparability of treatment and the pace of restructuring, because that has been the elephant in the room so far?
The Zambian situation is a hopeful one, but it has taken a very long, long time, right? So the Zambians have just recently concluded an agreement between the official and private creditors. And everyone is cheering that, and that's very good news. But it demonstrates just what happens when there is no international mechanisms that deal with sovereign debt problems. For individuals and also corporations, we have bankruptcy laws. We don't have anything recognizable for sovereign debts. And the G20 Common Framework was supposed to provide such a mechanism, but it has so far failed to meet expectations. We have called for the G20 Common Framework, which is the only mechanism we have right now, to work better, right? And it could be made to work better by just doing a few principles, right? One of them is just to bring the commercial creditors and the official creditors into the room all at once to negotiate instead of having these sequential kinds of negotiations, which of course drags the process and takes too long. You could also just have a formula upfront that is very transparent, that all creditors can use in order for comparability of treatments to ensure that some form of equal burden sharing. So that too can really speed up the process. And in the meantime, when the countries come to the debt negotiations, or they come under the common framework, it will be important for during that duration, perhaps to suspend debt service payments. And then finally, I think it's really important to open up the process so that other countries that are just not necessarily low income debt distressed countries, but they could be low or middle income, but they're still dealing with debt problem, can also be part of the process and can come under the common framework. So with these kinds of very simple common sense parameters or reforms, you could potentially have a very useful mechanism for actually resolving this problem. So you ask me if I'm optimistic. I'm hopeful, but that's not to say that I'm certain. So given the high level of, for the sake of these countries, given the high level of debt distress in the region, it's really urgent that the common framework work better for all parties if they adopt these common principles.
The World Bank in its latest Africa report is calling for transformative policy actions to build fiscal buffers. Now, considering the sort of environment we are in, where domestic revenue mobilization is struggling, we have a rise in the need for social spending. And as you rightly mentioned, we've got a number of elections in Africa this year. And therefore, in election years, I'm not sure taxation is an optimal route given the social costs. How exactly do you see this panning out?
African countries have actually, seriously committed to reforms, right? There's a lot to do. The reforms are not complete by any means. But I think the foundational story here is that it is really important to achieve some macroeconomic stability. And that means primarily starting with better debt management, including, as we've just discussed, possibility of restructuring or reprofiling some of these debts where necessary, right? And then, it's really, again, important to have better and transparent budgeting processes so that what you're spending the money on and how efficient it is. There is no escaping the importance of domestic resource mobilization. But you can design this, you can design the domestic resource mobilization around, say, strengthening tax administration, broadening the tax base, improving efficiency without necessarily actually burdening the poor, right? So you could do these things. So those are some of the core things that you can do. Now, in principle, then what you could do is you could also aim for fiscal progressivity. So what we've been calling for is perhaps, that these utilities that are consuming a lot of subsidies that are not profitable, they're not really properly managed, right? So you could, in principle, repurpose some of the subsidies, not necessarily take out. So, for example, some countries have decided they're going to provide a lot of subsidies for agriculture, and that's fine. But you need to balance between the short and the long term. There is an urgency to produce food right now, but there is also an urgency to try and invest in things like research and development that will actually create machines, technology, the seeds that will actually allow you to be resilient in the future, right? So those kinds of reforms are essential. VAT exemptions can be removed. You can get more sources of financing through property taxes or taxing the high net worth individuals. And then finally, the more crucial and the third crucial stuff is actually to try and make sure that there is a lot of market access because right now, a lot of our countries have all kinds of distortions. On the border, there are lots of tariffs. If they harmonize tariff, they have lots of non-tariff barriers. So opening up, removing these obstacles to trade, and eliminating all kinds of discriminatory laws, I think that will also usher in like market access and dynamism to the economies and build a lot of foundations for growth.
Andrew, to your point there, I read the report and I got the impression that the bank is significantly skewed in favor of adoption of wealth taxes in the African continent. And I'm just curious, to what extent do you think that conversation can be pushed? Because it has been on for a while in a market like Kenya, where we've been talking about taxing idle land, inheritance, for instance, but it has not really been actualized because of the sensitivities around the political dynamics of it. Do you see this finally being pushed?
In the end, this is going to be very important. As these countries begin to think very seriously about how they're going to actually mobilize more resources domestically, it's going to be impossible to avoid the importance of actually trying to think about alternative sources of financing. And, you know, the efforts to tax high net worth individuals, especially including, you know, through property taxes, because a lot of these high net worth individuals either have lots of capital gains or a lot of wealth tied up in property. It can be a basis for moving a society progressively towards removing a lot of these structural inequalities that we see, you know, that are very prevalent and that, you know, prevent higher and prolonged inclusive growth in the region. And, you know, taxation of property in particular is actually desirable in many ways, right? First of all, the revenue potential can be large. So in one of our studies, we found that in urban areas of most African countries, property taxes are paid only on around 10 to 20% of parcels. That's it, 10 to 20% of parcels. That's what the basic property, you know, the basis for property taxes have been for a lot of urban areas. But and African countries currently collect only around 0.04, like, you know, 0.04 to about 0.3% of their GDP in property taxes. If you just raise that share to 2% of GDP as they do in, say, some place like Europe, you could potentially gain an additional $60 billion annually in terms of revenues, right? And in some other studies, not necessarily in Africa, but that looked specifically at the US, if you just raise that to 5% of GDP, and in addition reduce, so wage, you know, salary, you know, taxes on salaries or wages, and even on capital, you could still finance your you know, government spending adequately, right? So the you know, there is a lot to like about, you know, moving towards these types of taxes because A, they're progressive. Two, they could gain you could get a lot of revenue. And third, they're actually not distortionary. They don't introduce a lot of distortions in the economy. You get a more efficient functioning economy along the way, right? So that is why I think these things are desirable, and we've been advocating for them.
Andrew, as we dial down our conversation, one of the most topical issues in the African continent so far in 2024 has been foreign exchange. You have seen rallies by the Kenya shilling, you have seen rally by the Nigerian naira. First off, the question being asked is this fundamentals driven? Because in Kenya's case, for instance, we go to the market, we refinance our Eurobond, shortly the shilling is on steroids. Are you seeing this as a trend that is going to stay or a flash in the pan?
To be honest with you, it's hard to tell. I think a lot will depend on how the investors see the reform process and the fundamentals holding. So, you know, yeah, you're absolutely right. Kenya shilling has been one of the best performing currencies in the last few months. You know, a few months ago, if I was sending money to Kenya, I was being quoted, you know, I don't know, 150, 155 shillings to a dollar. As of this week, it's 125, right? So that's how much it has appreciated. And you know, the kwacha has also been a strong performer. It has given ground a little bit, but it has been it's been one of the better performing currencies. since mid-March. Now, what I think what you see is that one good thing about this is that it is supporting fight against inflation. That is primarily coming from exchange rate risk and rising import costs that is passed on then through to consumers, right? And in addition, the strengthening of currencies basically brings back confidence to investors because they realize that, okay, the foreign exchange market has stabilized, that in fact, when they, with their investments, they can be able to get their inputs if they're importing inputs, they can get their inputs. If they are exporting, they can get, foreign currency if they want to. And so overall, then it supports recovery, right? So whatever the basis for it is, I think the fact that it's stabilizing is useful for bringing confidence and therefore for anchoring a recovery process along the way.
Already we have seen a bit of rejigging of monetary policy in the region. For the better part of 2023 and the latter half of 2022, we saw central banks assuming a very tight stance. We are seeing it being relaxed, barring what we have seen in the Middle East over the weekend. How do you see monetary policy for Africa playing out in the remaining period of 2024?
Inflation has been raging. It's coming down now. The median inflation in the region is falling from 7 to about 5% because global supply chains are normalizing. Commodity prices are coming down. They're still high, but they're coming down, although we have to watch what's going on in the Middle East. And so the monetary policy has in tandem raised interest rates, and that has also kind of kept a lead on inflation. Now, and then the other recent drivers that we just talked about, such as food prices for structural reasons, but also the weakening currencies have kind of begun to stabilize. However, there is a diversity of experiences in Africa, right? So although overall inflation is coming down, and for most countries it has stabilized, 80% of the countries are seeing inflation coming down. There is a dozen or so countries where inflation is still extremely high, in double digits. And even though even they are experiencing downward inflationary pressures, the rate is still very high. So what we suggest is that it's now time to have a mixed kind of monetary policy reaction. Specifically for those countries where inflation has now stabilized or within the central bank target, it may be time to either pause any increases or even begin to actually wind down these high interest rates. For countries that are still experiencing high levels of inflationary pressures, then it is really important to continue to actually use monetary policy tools to try and bring inflation under control.
When it comes to the discussion around domestic debt markets, if you look at a market like Kenya, Ghana, Nigeria, we saw elevated yields for domestic instruments in financial year 2023. When you look into 2024, do you see the pressures easing, the cost of borrowing for governments coming down?
Two things have to happen simultaneously. First, the global economy has to recover. Inflation in an advanced economy has to come under control, and the monetary policy that is prevailing now begins to relax a little bit, especially when it comes to interest rates. So that is going to be important. And then the second thing is going to be how the fiscal consolidation and macroeconomic stabilization efforts and reforms in our own domestic economies are going to take hold. So a combination of those two is what is going to lead to easing of financial market conditions for the region.
Andrew, give us your parting shot as we close this conversation.
African countries, I think, have gone through a very difficult time. The poly crisis is not completely over, but I think we are beginning to see the return of macroeconomic stabilization in many of these countries. The situation remains very difficult. I don't want to underplay that. But I think African countries have done reforms, difficult reforms in the past. They can do it again. And the most important thing in the end is really domestic reforms. And that is what's going to be superior to whatever else is happening in the rest of the world. And so my plea is to urge African countries to continue to stay the course of reforms along the way, because that's going to be the foundation for a robust and sustainable growth.
Andrew Double-N, Chief Economist for Africa at the World Bank, thank you so much for your time.
Thank you so much, Julian, for having me.
We have been having our conversation with Andrew Double-N, the Chief Economist at the World Bank, covering a raft of issues, including the latest development in the Middle East and what it means for African economies such as Kenya. Andrew tells us that that complicates the environment we have been dealing with, which has been called the poly-crisis environment, coming from COVID-19 to Russia, Ukraine, and its spillovers. And now we have developments between Israel and Iran. We wait to see how that unfolds, so stay tuned to Business Redefined.